Hello class. Today we'll be explaining the concept of risk and return in regards to financial decision making and their relationship. But before we explain the relationship, let's evaluate these terms independently. First of all, risk can be described as the level of uncertainty an investor has in an investment, and return can be described as the profit or loss from that investment. Now, in explaining them together, low risk investments means that they are very safe, however, due to their safe nature, tend to yield a lower return. On the other hand, we have high risk investments, which means there's a high level of uncertainty that that investment will pay off. However, if it does pay off, the returns could be huge. Okay, next I will be presenting the scenario analysis, which was my real life investment options on the Robinhood app. First is low risk, low reward, which I could go with by putting my money into a high yield savings account on Robinhood, which averages about 4% return a year and virtually no risk involved. Secondly, I could go with an ETF, a major ETF like SPY, which yields about 10% return on average, but does have some risks involved with it in terms of a market crash. And then finally, I could have gone with a high risk, high reward, which would be investing in individual companies. If you hit on an individual company, there could be a huge return involved, but there is risk that that company could at any point go bankrupt, and you could lose a lot of money as well. Ultimately, I decided to go with what I would call the medium risk, medium reward scenario of investing my money into the ETF SPY on Robinhood. But before I break down why I did that, let me first break down why I didn't go with the other two options previously mentioned. So I didn't go with the low risk, low reward scenario of investing my money into the high yield savings account because I see this more as a way to maintain wealth than to obtain wealth. And when I started this personal investment journey, the goal was to obtain wealth. So that one was off the table for me. On the other hand, I'm a little too risk adverse to go with individual companies just because if any of those companies were to ever go bankrupt, I could lose all the money I had in that company. So like I said, the 10% a year average since 1993 on SPY was safe enough for me to want to feel comfortable investing in it. And then also the 10% a year was enough money over time to where I believe I could gain some real wealth from this investment. In conclusion, when I was forced with making my decision on risk versus reward, I ended up choosing the middle ground. I did this because I want enough reward to be able to accumulate wealth over time, but I wasn't willing to take high risk in order to get there. Now, because of this, I know I'll never get rich quick with this method, but personally, I'm okay with that due to my risk tolerance. In theory, the risk versus reward relationship follows simple supply and demand economics. For example, if an investment is inherently risky, this will scare off many investors, decreasing the demand and thus decreasing the price. But if an investor truly believed in this investment opportunity, then striking while the demand is low could lean to higher returns. However, there's also a high chance that they could lose money in this investment. Now, for practical application of this theory, an investor must determine two things before making an investment. First, they must decide what their goals are, and second, they must determine what their risk tolerance is. If an investor determines both of these things before going into an investment, they can go into the investment confidently.